Hi there, welcome to Kneppy Invest. 1 year ago, I asked the viewers of this channel to provide me with three companies they thought were going to outperform the market over the next 5 years. I collated the results and came up with a group portfolio consisting of about 30 companies. And this portfolio, this strategy was a completely passive strategy because I was not going to sell or buy any companies within this portfolio. And I also wanted to see how a completely passive strategy would work over a 5 year period because I have heard that completely passive strategies can significantly outperform the market. I am skeptical about that because I do believe you need to be a little bit active when it comes to investing. So we are at the end of the financial year. So I have provided in this video 1 year performance updates. So I've been providing these performance updates every month. Now we're up to the 1 year performance update. And to be frank with you, it's not a pretty sight, as you're probably well aware. The market is down during the financial year 22, particularly in the second half of the financial year. We are down big, and particularly in June, the markets did fall quite a bit in this month, which actually makes me think that in July or even August, we might see a little bit of bounce in the markets because, of course, during bear markets, it doesn't go down in a straight line. You do see quite a few relief rallies during a bear market. And so I do think we are in store for a potential relief rally over the next month or even 2 months. So let's get stuck into it. But the other thing I should mention is not only am I tracking the group portfolio, I'm also tracking the group portfolio against two of my own personal portfolios using different strategies. And those two strategies are based off short-term sentiment. We'll probably call that short to medium-term sentiment and momentum and trends, that sort of thing, which is something I've developed over the past few years, something I have learned that is very important when it comes to share price movement. In fact, if you ask me right now, what is the main determinant of the share price of a company moving up or down, I'd say it's sentiment. Even in the long term, it is still sentiment, but sentiment can be driven by many different factors, including the financial state of that company. And the other strategy I use is a long-term buy and hold. And I've been using that strategy ever since I started investing. So I was of the belief, because this is what we are told, that you find a quality company, buy that company, and never sell that company unless the story changes. And I started using that strategy when I first started investing well over a decade ago. But my strategies are evolving with time. At this point in time, it looks like I am going to sort of merge these two strategies together into the one strategy. I'm actually developing a checklist based off three things. And those things are value, quality, and sentiment. And in fact, when I look at my current checklist that I have already developed and look at some of the companies within these portfolios, quite a few companies will not be able to get ticks on many of my checklists. So I'm thinking I'm going to do quite a bit of trading over the next few months to weed out those companies that I don't think would fit into my new strategy. And the other reason I probably haven't mentioned yet, the other reason why I'm changing my strategy is I've turned part-time in my work. So I've gone from full-time to part-time. As a full-time worker, I was definitely more of a risk taker. Sometimes I could be even described as being cavalier with some of the choices I make. And right now, as I've become part-time, I think choosing investments is going to be much more important. I'm going to be a little bit more focused on quality of companies. And when I'm talking about quality of companies, I'm not talking about storied companies. So, for instance, BrainChip, Lake Resources, Novonix would not filter through my current checklist because they are story stocks. They are not quality stocks because they have either very little revenue or no revenue at all. So look out for videos in the next few weeks about my new strategy and my new checklist based off value, quality, and sentiment. Because I usually update these videos every month, I thought I would actually show you the XGO monthly going back to 2010. And the XGO has been trading in an upwards sloping channel over the past 11 years. And whenever we get to the bottom of the channel, we do see the XGO rally. Whenever we get to the top of the channel, we see a bit of a drop in the XGO. The only time the XGO has gone below the bottom of the channel was during the COVID-19 financial panic. And then we saw a significant bounce off the long-term trend. The long-term trend is that sloping blue line. We have seen the XGO hit that long-term trend twice in the past 13, 14 years, once during the bottom of the QFC, the GFC, and once during the bottom of the COVID-19 financial panic. So the long-term trend is working now. And during the past, say, since the start of the financial year, we have been trading towards the top of the channel until June. June, we did see a significant sell-off in the XGO. In fact, the XGO was down about almost 10% for the month, and we are moving towards the bottom of the channel. So if we do see the XGO get towards 6,200 over the next few weeks, that could be a good buying opportunity unless we move into a significant recession, and a significant recession could force us down towards the long-term trend. Now to some statistics in regards to the XGO for financial year 22. So July 1st, 2021, we started at 7,313. We ended the first half of financial year up. In fact, it was up a fair bit, up to 7,444.6. And then we started to go down, a fair bit of volatility from the start of the calendar year, January 1st, all the way through to the end of May. And in fact, at the end of May, we're only down a little bit, 230 points, down to 7,211.2. Unfortunately, June was a significant down month. We went from 7,211 down to 6,568.1. The XGO was down 9% for June. That meant for the year, down 10%. And for the half year, down 12%. So the majority of the downturn in the XGO was during June. And that's why I do think there is potential of a little bit of a bounce in the XGO in Australian markets over the next we'll say 1 month, possibly even 2 months, going back to sort of the short-term trend, which is still down. We're still negative sentiment in the markets. But again, as I've already mentioned, you do see a lot of relief rallies in bear markets. And right now, it does look like we are heading into a bear market. Now to the performance of the group portfolio, and usually in these videos, when I do a 1 month update, I just show you the previous month and then look at the updated month. But instead, I'm going to go back to the end of the half year in December, and everything was going perfectly well, not only for the group portfolio, but also my long-term buy and hold portfolio, both up over 15 to 16%. So the group portfolio at the end of December was up 15.2%. Some really good gains here. So at this point in time, Novonix was performing really well. Lake Resources were performing well. BrainChip, Unity Group, Talgo Group, Province Resources, and ResMed all up over $200. So at this point in time, nothing to be concerned about. Your group portfolio was significantly outperforming the market, and we should expect this. In this portfolio, a lot more risky story stocks, and when times are good on the market, these sort of companies should be performing really well. Unfortunately, when we do see a bit of a downside, when we do see bear market, these sort of companies should perform much so significantly worse than the more mature companies like Coles, Woolworths, and even the banks. And that's exactly what we've seen over the past 6 months. Now to the group portfolio performance for financial year 22. So you remember at the half year mark, it was up 15.2%. At the end of the financial year, it's down 27.3%. So a significant downturn during the half year, particularly in June. In fact, at the end of May, the group portfolio was down about 4,000 or 4%. Now it's down 27.3%. So you can see how bad June has been for the overall market, particularly small cap companies. Now, down 27.3% might sound bad, but the small cap sector, the XSO was down about 20% since the start of financial year. So this is to expectations. And when you look at the makeup of the group portfolio, there are a lot of story stocks, a lot of small cap companies in this portfolio. So you should expect performance of a lot of these companies to be down for the financial year. Only 4 companies in the black, so only 4 companies have risen over the past 12 months. And those companies are Lake Resources, BrainChip, Unity Group, and Novonix. But the majority of those companies, apart from Unity Group, are down big over the past few months. And in fact, at the end of May, the group portfolio was only down 4%. So you can just see how bad June was. It went from being down 4% to being down 27.3%. Now, nothing to be too concerned at this point in time. This is to expectations when we are in a down market. But when we go back to the market going up, back into an uptrend, we should see the group portfolio significantly outperform the overall market, unless a lot of these companies go bankrupt. Can't really see that at this point in time, but we should expect some good things moving forward. But we will have to wait for the market to turn around. And one of the things a lot of investors make, particularly new investors, they see their portfolio down big in a bear market and they sell out near the bottom. We don't want to do that. In fact, that's the time to buy. You should be looking at adding to your portfolio right now. I am building up a checklist or watch list of companies I want to buy for the long term. So really quality companies. So when the market starts turning, I can take advantage of this down market. A lot of investors do the complete opposite. They sell near the bottom and they will only start buying when everything turns around. And I still remember back in 2011, 2012, there's a lot of people telling me, you're crazy being in the markets. This is not the time to be invested in equity markets. It's too dangerous. It's too risky. That was the time to start buying into equities. 2011, 2012 was perfect time. So this is the time to get excited if you are in equities, because we are moving down. I don't know how far we have to move down from here, but this is the time to start taking action. Now, when it comes to tracking the group portfolio and the other two portfolios, I'm tracking against the STW, which is an ASX 200 fund. The reason I want to track it against the STW is because that includes dividends. So when you do track against, say, the XGO, you're not really including dividends. So the STW capital gain down 12.3%. But if you had invested in the STW, you did get 8% dividends during the financial year. So overall, we need to take into account capital gain and dividends. The STW was only down 4% for the year, while the group portfolio was down 27.3%, capital gain down 29%, and dividends 1.72% gain there. And on the top here, I have tracked the performance of the group portfolio and the STW since the start of the financial year. When the market was going up, again, the group portfolio was outperforming the STW. That should be to expectations. And at one point in time, it was significantly outperforming. But then as the market started to turn down, small caps became out of favor. A lot of these companies in the group portfolio started to move down. That's when we started to see the STW outperform the group portfolio. We could just see the group portfolio over the past month really start to accelerate downwards. This will come to an end eventually. We will see a bottom, and that's when the group portfolio will catch back up to the STW and then overtake it. Because don't remember, over time, the markets do go up. They don't go up in a straight line, but over time, they do go up. And when they start going up, that's when you should take advantage, and that's when the group portfolio will catch up to the overall market. Now, I very rarely show individual charts in these group portfolio performance update videos. In fact, this could be the first individual company chart I have shown. But Novonix is a perfect example of what's happened on the ASX over the past year. So 1 year ago, July 1st, Novonix was just above $2, and the share price rallied from $2 to a high of $12 in about 5 months of trading. And then we had that massive big down day, start of December. I think the Novonix share price fell about 30% in 1 day. That was a sell signal, in my opinion. You never want to see that. There was also really high volume on that day. We did see a bit of a rally in the share price of Novonix over the next month and a half. Share price went from $8 to about $10.50, which was reached in halfway through January. But since halfway through January, share price of Novonix has been consistently falling. It went through a fairly strong support level at $4. I can see the share price just hovering around $4 during most of May, but since the start of June, share price of Novonix has fallen from $4 to a current share price of $2.28. So this is very typical of many companies, particularly small cap companies on the ASX. We have seen a bit of a correction in the share price. Doesn't mean the share price of these companies will continue to fall, but in my opinion, Novonix valuation is still fairly high, so there could be more to fall unless we see a significant shift in sentiment over the next few weeks, next few months. And I think that shift in sentiment is doubtful simply because of the economy at large and the potential we might be moving into a recession. So we still could be seeing a downside from here. But in saying that, I did see some really interesting signs on the last day of June. So a lot of companies that were beaten down a lot did see significant rises in the share price. There was one company I owned whose share price rose 25% in 1 day. The only problem with those significant rises in share price for a lot of these beaten down stocks was it was on low volume. I would have preferred some higher volume there. So possibly we're starting to see the first signs of the market trying to shift sentiment. But I still think there is potential more downside to move or to go from here. Now to the performance of my personal portfolios. And first of all, we're going to be looking at the long-term buy and hold portfolio. And there is a slight difference between this personal portfolio and the group portfolio. The group portfolio is completely 100% passive. My personal long-term buy and hold portfolio is not passive. And at times, over the past 9 months, whenever I see the share price of a company rise up quite quickly, particularly exponentially, I will take profits. So that's a big difference between this portfolio and the group portfolio. I will take profits in this. And it has been successful over the past 9 months, because when I look at the 10 best performing companies in this portfolio, 8 of them I've completely sold out of, including Beam Communications, Revisum, Alexium, MyDeal.com, because I think there's a takeover bid for that company, EnviroSuite, Ambertech, Australian Clinical Labs, and Aussie Broadband. So I'm only holding 2 companies that are the best performing companies in this portfolio. And one of them, BrainChip, I did take profits. The share price got to $1.50. Share price is now 80 cents. Maybe I should have taken complete profits when it comes to that company. The other best performing company, and it's 10th on this list, is Fiducian. And this is a company I hope and expect to own for the long term, say 5, 10, 15, 20 years, hopefully. And when you look at the performance of that company, only up $606 for the financial year, and half of that is through dividends. So the main difference between why the group portfolio has underperformed my own personal long-term buy and hold portfolio is because I've been a little bit more active over the past year. I think sometimes that will not benefit my performance. So some of these companies could have kept on going up after I took profits, but that did not happen. So that's the one difference between the 2 portfolios at this point in time. At the end of May, I had about $33,000 of cash in this portfolio because I had been selling out and not really buying any companies. I've shifted my strategy for this portfolio where I will be starting to draw down my cash level. So I want to increase my holdings in this portfolio, and I will be using or deciding on any purchases using my checklist, using quality as a key consideration, using value as a key consideration, using sentiment as a key consideration. And using that checklist I do have right now, I decided to make 2 purchases at the start of the month, Closed Loop and also Ballador Tech. So I bought those companies towards the start of the month. And fortunately, Close the Loop has gone up. So even though the overall market is down, Close the Loop has gone up since I bought in. And Ballador Technologies has remained steady. So fortunately, even though I did make those purchases towards the start of the month, we are in red in either of those companies. I did sell one company halfway through the month, EnviroSuite, just to build up my cash levels again, because at this point in time, I would not consider EnviroSuite to be high quality or even of value, because the company is loss-making by a considerable amount. It is also burning through a lot of cash. It does have promise. So what I'm going to do is leave EnviroSuite onto my watch list. And when I see it become operating cash flow positive, free cash flow positive, that might be the time to take a position in the company. The other thing is sentiment. Both Closed Loop and Ballador Tech have some positive sentiment behind them. That's why we have not seen the share price of either of those companies come down. When we look at the overall performance of the long-term portfolio, very similar to the group portfolio, the long-term portfolio was outperforming the STW when we were seeing the overall market go up. Only recently, the last few months, have we seen the long-term portfolio underperform the STW. But when you look at just capital gains, my long-term portfolio did outperform the STW. It's only when you bring dividends into the picture where we saw the STW outperform the long-term, because the STW had a dividend yield of 8%. The long-term portfolio had a dividend yield of 3.5%. Overall, long-term down 7.7%, STW down 4.3%. Now, 1 month ago, I realized the strategies I was using in my 2 portfolios were completely wrong. I should have flipped them. So I was building up my cash reserves in my long-term portfolio, and I was almost cash zero in my short-term sentiment portfolio. It should have been reversed. I should have been building up my cash levels in the short-term sentiment, and I shouldn't really be caring about whether the market's in a bear market or anything like that in my long-term portfolio. So I've actually significantly shifted my strategies in both portfolios. So I am building up my holdings in my long-term portfolio and building up my cash levels in the short-term sentiment, simply because in the overall market, we are negative right now. We're in a potential bear market. The trend is down. So I've really built up my cash levels. You'll be able to see all the transactions I have made in the next slide. And right now, there are a few companies I'm thinking of selling over the next few weeks. In particular, South32, which I've held for 2 months, trend is shifting. Share price is starting to move down. That is my best performing company over the past few years. Even John Lynn's Group, definitely, you could argue I should sell that company because trend is down. AGL Energy, trend is up for that company. Some good positive sentiment around AGL Energy right now. Neuron Pharmaceuticals, West African Resources, IPD Group. Some of these companies' trend is still up. West African Resources is an interesting one. Trend in that company is still up, which is quite different from a lot of other gold companies on the ASX, because gold at this point in time, for some reason, is looking quite bearish right now. MMMA offshore is up. Even Treasury Wine Estates, there's probably no trend in that company right now. It's just going sideways. Share price is just going sideways because that could be a sell as well. The worst performing companies right now, they do hold Costa Group, Pac Gold, NRW Holdings, Metro Mining. Quite a few of those companies I probably could sell because trend and sentiment in those companies is negative right now. And one of the main reasons I haven't gone more to cash is simply because I didn't want to sell out most of my holdings. I want to be gradually sell, and that's what I've done during June. I gradually sold out of some of my holdings. So I've sold out of Aussie Broadband, Northern Star, Mac Limited, Smart Group, Capricorn Metals, DGL Group, OFX Group, and New Farm OFX Group. There was some pretty good profits with that because I've held that company for about a year, but the trend in that company has turned. So I've sold out of, 8 companies, which has added $27,790 to my cash. And right now, my cash levels are at $36,156. The best thing about this portfolio or this strategy is right now we are actually outperforming the market. So only down 3%, while the overall market or the STW is down 4%. When you look at capital gain, the short-term sentiment portfolio is only down 5%, while the STW is down 12%. And really, one of the reasons this fascinates me is because for the first about 4 or 5 months of the financial year, I was ignoring this strategy completely. It was only until the start of the financial year or the calendar year when I started paying a little bit more attention to this portfolio. And that's when we started to see this portfolio outperform the market. Unfortunately, the last few months, this portfolio has gone down almost the same rate as the STW. So it has really followed the fall in the STW or the overall market. So right now, I'm looking for companies that there is some positive momentum behind the share price, and that those sort of companies are hard to find because there is a lot of negative sentiment in the market, and a lot of companies are in downtrends right now. So I'm looking for companies that are in uptrends. They are few and far between. Now, looking at the performance of the 3 portfolios I am tracking versus the STW, we'll be comparing the financial year 22 numbers to the 11 months, so up until the end of May, also comparing to the half year numbers, which we had at the end of December. So everything's in the red. So the STW down 4%, group portfolio down 27%, short-term sentiment down 3%, and the long-term down 7.7%. Significant decreases when you just compare 1 month ago. So 2 of the portfolios, one of the portfolio and the STW were actually in the green at the end of May. Short-term sentiment up 3.9%, STW up 3.7%. So you can just see how bad June was. Even the group portfolio went from being down 4.5% to now being down 27.3%, and the long-term buy and hold down 1.7%. Now down 7.7%. But if we compare to the end of the half year, everything's gone from being in the green up a fair bit to being in the red. STW only up 4.7% at the end of the half year. Compare that to the group portfolio up 15.2%, long-term portfolio up 16.7%. So again, when the overall market is rising, we should expect the group portfolio and 2 of my personal portfolios to perform better than the STW, simply because of the companies that are in the STW compared to the companies within the group and personal portfolios. And even the short-term sentiment was performing better at the half-year mark, up 5.5%, even though I had been ignoring that portfolio for about 4 to 5 months. So that's all I have for this one-year performance update to the 3 portfolios, including the group portfolio and 2 of my own personal portfolios. The financial year is done. Financial year 22 is over and complete. Now we're into financial year 23. It was a very bad end to the financial year. June was by far the worst month I don't think any other month compares to what happened in June. I would not be surprised to see a little bit of a good start to financial year 23, but a lot of uncertainty, not only in the markets, but the economy at large. Will we move into recession? Those sort of questions need to be answered over the next few months. It would not be surprised, I would not be surprised to see significant hard times in economies around the world over the next few months. So that's why there is potential for the markets to fall further from here. But now is not the time to sell out of the markets completely. Now is not time to sell and say this is not for you. Now is the time to start thinking about buying, particularly if the markets keep dropping. I am starting to see some good value out there of some really high quality companies. So now is the time to draw up a watch list of those companies you want to own for the long term, particularly if you are a long term buy and hold sort of investor. So if you do have any questions about any of these portfolios, anything I've discussed in this video, please leave a comment in the comment section. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.